Hello, my name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Nicole Urken, Senior Stock Analyst at The Street.
And together we bring you an actual special segment. Okay, we are in December. It's a time of the year when different portfolio managers, stock investors, market participants, they all try and think of some type of positioning for, the last month of the year as well as the first few months of the year. So with that being said, there are some phrases on Wall Street that go around, whether it's, strong stocks and stronger, or the dogs of the Dow. There's lots of different, type of sentences that people talk about, but they all are there for a reason. So with me, I have Nicole, and Nicole has done a lot of research on what has been, what are the dogs of the Dow and the reason being for them. Right. So with that said, she's going to come and talk about why the actual dogs of the Dow exist and why there could be some potential just good plays going into the first of the next year.
Yeah, and exactly like you said, the market has been so strong this year. Actually, if we look, the dogs of the Dow, we were joking before, one of them is actually up 11% for the year. That's Coca-Cola. So when we're thinking about dogs, they're not necessarily extreme underperformers. Going into the end of the year, Scott, you have to think some of these are dangerous. We talked about tax loss selling. Also, there's been Jim Cramer talks on Mad Money a lot about the anointed ones. Momentum names tend to do well into the end of the year because managers want to own them. If they were the hot stocks, they want them in their portfolio. So I think we have to differentiate between opportunities in 2014 versus the end of the year. So as we go through these, I would caveat that they're dangerous for the next couple of weeks going into the end of the year.
Well, the beauty of us is we could be market timers. We could look for a technical signal on when potentially it's ready and when it's not. And like you said, the reason why strong stocks end stronger is because nobody wants to sell them and pay taxes. Same way portfolio managers want to have them on the books. So with the dogs of the Dow, the reason why it's the opposite is because these stocks have not performed. So with that being said, it's almost embarrassing that if you're a portfolio manager and you pick them, so come the last month or two of the year, you try and get them off the books, so that creates undue pressure. And then if you're an investor and it happens to be one of your 6, 7, or 8 stocks, you might just sell that one even if you like it and it's not the right price because you have so many gains elsewhere, so that puts pressure on it. So what that does, if you're not caught in it, it creates an opportunity. And so with these big, multinational names, which some of them are, that didn't perform, perhaps there's going to be some opportunities going into the next few weeks or the first months of 2014. So we're going to go stock by stock, and I have the luxury of having Nicole here, who's done a lot of research on this. So let's go with the first one.
Great. So IBM's first. That's down 7% for the year as of the end of last week. Now, this has been a name that has not improved its revenue at all in 4 years. The EPS target, they laid out this really strong 5-year plan, and the EPS has been boosted by stock buybacks. We had a new CEO come in. Not much has happened. If you were a bull, the trade here would be it's a corporate spend improvement play. It's a very big cyclical name, but Scott, it has no growth. People want growth here. People want the Salesforce.coms of the world. They want the Workdays of the world. They want cloud, and IBM is just really late. It's unfortunate because they actually sold their PC business. They were ahead of Hewlett. They were ahead of Dell back when they did that. But then they kind of lost their way in software and services, and I don't really see any reason to own the stock right here.
Well, that's good, because about a year ago I was here, wasn't with you, I think it might have been with Jill, and I said in my 2013 thesis, the one surprise or the one spot not to be is IBM for a lot of those same reasons. So even though it didn't fall apart, it wasn't an unbelievable short, your money wasn't best served in IBM. So now let's look where it is now. You look at the chart of IBM, and you'll see that you had this small little breakout failure. This is when everyone was yelling at me like, "Red Dog, you're wrong, you're wrong." And meanwhile, look what happened. Came back up, and then since then it's been in a downtrend since. We talked about big support here at this 190-ish area, which broke below. You want to look at the channel that it went below. You go to the monthly. Look at the size of the move that it's had, so it has some room there to the downside. So overall, I'm not saying it's a screaming short, but you do have this area, this support to trade against. It's 172.57. If it were to break below that, perhaps I think there could be some decent opportunity. Maybe the 150 area if you had to be involved. So out of the dogs of the Dow, I think that this is something that could be a trade from time to time, but I don't think you put money in there for the longer term.
Got it. That's helpful. And I think in another completely different sector, let's look at Caterpillar. Caterpillar is also down this year about 5%. Caterpillar has had a tough run because bad timed acquisition of Bucyrus. They also acquired this Chinese mining equipment called ERA for $650 million, which they essentially had to write off right away. There's been some management issues here. And I call that into question in particular because we've seen strong results from Terex or United Rentals, other names in the sector. Now, just this morning, Scott, we got bad results from Joy Global. So certainly this whole group is challenged. I think, again, if I want to play the bull side, it would be China. It would be, you believe in the China comeback. But I think there are better ways to play China. Eaton, Cummins, better managed companies. And that's what I would say here. I think it's a trade, but I think there are better opportunities.
Okay, it makes sense. And a lot of times throughout the course of the year, I feel like people are trying to make excuses on why they need to be in Caterpillar because it's been so good in the past, but just right here, it hasn't been. So technically, there's a nice little pattern here, though.
Yeah.
You want to take a look at Caterpillar. I look at tight setups, and if you look at the chart, you will see that Caterpillar is getting very tight here. You're talking about a very, very tight channel going sideways for multiple months. So with that being said, you don't even really have to guess, but you could say, okay, if this story is going to continue to the downside, a break and close below, just say this, 82 area would get you a downside move. If on the bullish side, China does continue to get a little bit better, and people get, I think a lot of people are talking about good things for China, and it does want to get new portfolio managers in it. I think above, just say 87 to this little spot here of 88 could be your move to just watch. So if it gets above 88, I do think, though, there could be a long opportunity back up to the 95 to 100 range for this because it is so tight. At least we have points of reference. And out of a lot of the dogs that I think that this one, is going to be on my radar for a bit of a comeback.
I think that's a great point, Scott. Just to add, Stephanie Link just actually bought Caterpillar for the charitable trust. Again, relative, I think Eaton is better positioned. But as we've seen, we were talking about this earlier, when a stock's bad news is baked in, it can really jump if you get even an ounce of good news, whether it be out of China or actual improvement in their operation. So I think also there's some yield support here. So I do think Caterpillar could be a very interesting trade. I think there are better names, but certainly you could lock in some nice games. And I think that pattern that you're seeing, it's leveling out. There's some support helped by the dividend as well and the bad news out there. So let's move to at&t. This name's actually up for the year, so we don't have the tax loss selling problem as much, but it is a dog, up only about 2%. I would say here, again, there's a relative value question. Verizon now owns 100% of Verizon Wireless, so it's a better wireless play. That was the trade-off before, why in the past I've looked at at&t. That said, at&t, a high-quality company, potential acquisition. We know the CEO is looking to grow. I think that that's in the cards here. It's a high-quality company. I don't think you're going to see real outsized growth, particularly as rates go up. A lot of people own at&t for its 5% dividend yield. Right. That's not as favorable going into 2014. But I don't think there's that much downside here.
Well, we'll look at the chart and we'll see what happens. If it does continue to go to the downside into the end of December, you look at the chart, you'll see here there were spots to see as far as being a seller. We talk about just say an outside day, and here you had an outside day back in October. That was your sell signal. Then you had a potent move to the downside, lower high, and now today it's breaking below another area. So this so far is giving you absolutely no signal to be long it. But what you do have is some big time support. So, over multiple months, which goes back almost 2 years. So with that being said, if it does get pressured and continues to fall lower, perhaps look for some type of reversal strategy into this 33, because once again, you don't get these high quality names sometimes for sale, and if this were to hold, that would be a good spot. But you have to examine it closely because this goes back way back when. So if this doesn't hold this 33, the next real support that comes in on at&t doesn't come in until all the way down closer to 30. So I would say into the next month, watch this area, see if it holds or if it breaks.
Got it. Let's move on. We have Cisco up 8% for the year as of the end of last week, though it is getting killed today. I think Cisco is an interesting one just because of how much it's gotten killed of late. It was downgraded today, or rather initiated with an underweight. I think Cisco is interesting. In a year, it's going to be considerably higher than it is right now. That said, one of the reasons the stock is down so much is it reported a horrendous quarter. In fact, they should have pre-announced. And so there's a credibility issue. Can management forecast what's happening in the macro environment and for the company specifically well? And I think that's a real question mark. It's hard to come into a name when there's that much uncertainty. So I do think there's a more long-term opportunity here, but I think we'll see a lot of messiness until we see real signs of a turn?
Well, the whole thing, like you said, credibility. This stock was on its highs expecting a good report, and then a lot of people got blindsided. So that leaves bad memories and like, footsteps, so to speak. So
anger.
With that being anger.
And
so
stocks can be emotional, which could provide an opportunity.
Right, but people do forget.
Right.
And I remember over a year ago when Cisco was 17, everyone in the world hated it. It had a great run.
Right.
So like you're saying, I think, 1 year from now, high probability, will it be higher? I do think so, but it's probably going to go lower first. So let's look at the chart. You look at the chart of Cisco, and it's like bipolar this year. It started the year higher. Everyone here thought it was, going to continue, and then at the highs, boom, look at that gap down. Okay, came back up, rallied back, made a lower high, same thing. And look where it was heading into the last earnings. All right, so this went out on the dead highs. So people were expecting a lot, and then boom. So now here you are, you have this huge gap to the downside, a pro gap where no buyers came in, so that shows you how weak it is. Today it's actually breaking below this low pivot here. This price was what, 2077. So now if you look a little bit longer term, you will see there is some support coming into 20. So let's see how it handles 20 coming into the end of December or January. Look for some type of reversal pattern. If that were to break, then I would have to assume that we're starting off the year on a pretty negative note because the next spot doesn't come till 19. But it's streaky. Look what it did here, at 15. No one would have thought it would have been 26. So so right here, if you're not caught in this mess, I think between 19 and 20, we'll look at it closely to see if there's some type of red dog reversal that can give you a signal for an entry. Right now, it's still under pressure.
Completely agree. Moving on, McDonald's, it's a name everyone knows. A lot of people are surprised it hasn't performed so well. I think one of the big reasons is competition in the U.S. We saw Wendy's have a huge run, though it's come off of late. Burger King turned itself around. A lot of that is because of innovation, and McDonald's just hasn't been able to compete on the same levels. I also would contrast it with a Panera or a Starbucks or a Chipotle. People don't go into McDonald's to have a chat, to do their work. No. And I think that's an area of suffering for them because that's a big move.
That is a big move.
Europe is a strong point. We just got their same-store sales out. But I think that right here there are better names to own. Chipotle, expensive, but it has more room to run. Panera is interesting because it's coming back, and I think that's an interesting one to keep out for. Yum, though, which had all of the issues in China, has really surged of late. So you can see when there's some...
You can kind of see why McDonald's has been out of play. I have a 5-year-old son, and he's only allowed to go once a week. I don't think there's any adult doesn't go to McDonald's by themselves.
Right.
Maybe some, I guess being a little opinionated, but I'm saying most people are health conscious. They're not saying, okay, I'm hungry, let's go for a Big Mac.
Right.
It's because your kid wants a Happy Meal, so maybe
and if
you go.
You have to look left and right to see if anyone's seeing you go inside. It's not something you want to be doing. It's not aspirational, which is, this environment is very aspirational. You have people that want to buy value. But this is why Michael Kors has done well too. It's an affordable luxury that people want to pay up for. People want to go into Panera, they want to go into Starbucks, they'll pay up. It's affordable but a little bit of a reach, and McDonald's, even though they're rolling out new initiatives, isn't a place people are really excited about going to.
You may go with your kid, or you may go on a rest stop on a highway because it's the only thing that you can pull off the road and buy. So anyway, let's get into the chart here. McDonald's been trending lower. Okay, here was your high, trending down. Here it looked like it was going to break the trend, but it had a breakout failure. Now it's kind of in the middle of no man's land. It's not at support. It's not by the trend where it's been failing. So with that being said, I would just look at it close here. I don't see anything compelling. If it were to start breaking below this 95, your next real support doesn't come into 93.5. And then until it actually breaks this trend line, if it were going to, and hold above it, look at this breakout failure. That's another, footsteps / bad memories investors have because they finally felt comfortable and then boom. So with that being said, short term, you have 95. If we were to break 95, you have 93, and that probably will be a better spot to look at, coming in the end of this month or perhaps in January. So this trend is controlling McDonald's. If this trend wants to change and this dog wants to turn into a darling, wait for it to break above that trend line and hold, and just keep it on the radar.
All right, 2 more dogs to go. ExxonMobil is next. When we think about the E&P or the integrated oil and gas plays, there are only 2 left. That's Chevron and Exxon. Everyone else is split up, Conoco, Marathon, et cetera, and that's created a lot of value for shareholders. Chevron has well outperformed Exxon. We're seeing a real reversal in Exxon, though. Why? 1, they actually showed some production growth last quarter. We haven't seen that in a while. And 2, Buffett's behind it. Now, Buffett's not the only reason to own this company. He's also owned IBM, and that has not helped you much. But I do think looking ahead, we're seeing a trough in nat gas prices. They bought XTO, obviously. And if we do see these continued strength in production growth, we want growth in production. That's very key. I think the company, which has been an extreme outperformer, could do well in 2014. I like this one here.
Okay, this one actually, like you said, had a big comeback, and it's just starting to trade lower, so it's a little different than some of the others.
Right.
But what's cool about this chart is you can look at it and you can see when a stock turns.
Yes.
And I can go over a little bit of a strategy on how some of these dogs that, don't need to be approached until they have that reversal, could just, be looked at, with one eye on it and one eye off it. So look at Exxon real quickly here. Okay, this stock got crushed, okay, of the summer all the way down. And then finally, September, October, it put a bottom in. So what does a bottom look like? So a lot of people in my little land of T3 or big land like the red dog reversal. And right here you had it, where it went below this prior low, okay, of 84, and then reversed above it and closed above the prior day. So that was your signal. Maybe finally we have a bottom here in XOM. So that's that reversal pattern. What you want to see from there is you want to see appetite down here at that lower level. So what happened? 3 quick days. So someone who missed it, they said, oh my goodness, look, it's cheap. 3 quick days. And then from there, even if you missed those 3 days, what you want to do is you want to see commitment. So here you have almost a bull flag developed where you have the move off the lows, sideways action, showing commitment, not pulling back, and then there you go. So now here you had a little bit of a reverse. Pushed through a prior high, came back below it, giving you a sell signal, and now you're getting followed through to the downside. So with that being said, this doesn't look like your normal dog of the Dow because of the strength that just took place. It's still just giving back the 8-day. Here's the 21-day. So I would say watch the 21-day coming into the end of the year. That's your last point of reference. And if things, got a little bit dicier here, I would say if this is any good, it should hold the 50-day moving average, which comes in right around 90, 95. So right now it's under pressure. Here's your 21-day. There's your point of reference, and there's your line in the sand.
Well, that's perfect because that's a stock that's coming up. We'll finish on a bubbly note with Coca-Cola. I know Scott doesn't need too much caffeine to keep up his very busy schedule. Coca-Cola is not doing well. Why? Because carbonated beverages are down. People are healthier, like we were talking about before. They want water, and even diet beverages aren't doing as well. I think the better play here is Pepsi, which also is not very expensive right here. They have their large snack business. There's some potential restructuring. We know we've had some activist murmurs about separating snack and beverage, which isn't likely to happen, but certainly supports a sum of the parts multiple. So I think here, I wouldn't come into Coke more because I prefer Pepsi. I also think some of the continuing deceleration, again, in carbonated beverages is a risk. It does have more in China. Again, if you want that China play, it could have a little bit of a trade because of volumes there, but it's not a favorite of mine here.
I used to drink 3 Diet Cokes a day. I think I'm down to maybe 3 a week, if that. So, and I think I even heard a report saying people looking at the chemicals in Diet Coke, and I don't think many people even drink regular soda.
Right.
So the health conscious trend could be taking a little bit away from Coca-Cola, and they have other businesses or whatever. So with that being said, let's just look at the chart. This chart is not as broken as some of the other dogs of the Dow, but you do have a high, a lower high. And then it did look like this trend got broken. You could draw it like this, which it's still, here's your descending channel here, broke above, sideways action. Here's your little outside day that said it needs a rest. And it's still hugging the 8 and 21 day. Sometimes it does come back and retest this area, so this would be support 2. So support 1, support 2. If there's tax law selling in it and it subsides, and if people want to put some new money to work here, it's going to have to get back above this area, and this area right now is about 40.50. So overall, from the highs to the lows, it's kind of middle ground here, but it's holding in. If it were to break this, there's your line in the sand for it to, be acting somewhat well.
Yeah, and looking at these levels is so key. I think one key takeaway from all of these names is, yes, all dogs can have their day. Yes, there is this reversion to mean trade that people look to, especially in January. But valuation is in the eye of the beholder. A cheap stock can stay cheap. It's all based on estimates. So if you don't see a real fundamental shift, or if you don't think all of the bad news is priced in, like it is with Caterpillar, maybe there's a shift at Cisco, you can't just buy a stock because it's cheap. And I think that is something I would warn investors. It's going to come up if we see a real shift in trends, or if absolutely everything in the bad news sphere is priced in, but a stock can keep going down even if it's cheap and even if it's underperformed. We've seen that time and again.
Right, and that's why as a trader you don't catch a falling knife, and you always have a plan. And the beauty of, again, these dogs of the Dow is, as technicians and technical traders, we're trained to look for reversal strategies. You see the reversal, you see appetite for it, and then you see commitment to it. And if you see that type of formula come in, you get to get involved with some of these names that other people are underwater with. And just like Nicole said, cheap stocks do get cheaper, same way strong stocks can get stronger. So what you want to do is you want to identify price, you want to identify your time frame, and you want to watch things closely. You have a plan, then you wait for the market to confirm that plan. And with dogs of the Dow, you do have these stocks that have been out of favor, and sometimes they come back, so let's look for the signals. But if you don't know what you're looking for, you're never going to find it. So with that being said, this has been your Dogs for the Dogs of the Dow segment here with Nicole. Thank you for coming.
Thank you for having me.
And we'll have you back soon.
Thanks.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.